For decades, the U.S.-Canada relationship has been the definition of stability. Quiet borders, integrated factories, shared supply chains, and a trade partnership so deep it was treated as permanent. Then, almost overnight, that assumption cracked. The United States didn't threaten China, Russia, or Iran, it threatened Canada. A 100% tariff, an economic weapon normally reserved for rivals, suddenly aimed at America's closest ally. That is the shock. Not just the policy, but the target. Canada isn't an adversary. It's the neighbor that powers American factories, fuels American homes, and anchors North American trade. And yet, with a single statement, stability gave way to uncertainty. Markets flinched. Diplomats scrambled. Allies took notes. So what actually changed? On the surface, this looks like a trade dispute, a disagreement over deals, deficits, and leverage. But underneath, something deeper is happening. This threat isn't just about money moving across borders. It's about who sets the rules, who gets punished, and who is allowed to choose their own path. Why would the United States risk damaging its strongest partnership? Why use maximum pressure on a country that helped build American economic dominance? To answer that, we have to look beyond tariffs and examine power, control, and the shifting logic shaping today's global order. The sequence of events itself is surprisingly simple, which is what makes it so unsettling. In a public statement, Donald Trump warned that the United States could impose a 100% tariff on Canadian goods if Canada continued deepening its trade engagement with China. No closed-door negotiation, no technical filing first, just a blunt, public ultimatum aimed directly at Ottawa. To understand the gravity of that threat, you have to understand what a 100% tariff actually means. It isn't a minor penalty or a negotiating nudge. It literally doubles the cost of every affected product the moment it crosses the border. A car part, a machine component, a barrel of oil, instantly priced out of competitiveness. In global trade, that level of tariff is considered extreme, closer to a blockade than a dispute. Historically, the U.S. and Canada simply don't operate this way. Trade conflicts between the two countries have existed, but they were narrow, legalistic, and slow-moving. Lumber, dairy, steel, arguments handled through panels, courts, and years of negotiation. This threat skips all of that. It jumps straight to maximum pressure. That's why this moment feels different. This isn't a technical disagreement over trade rules. It's a warning shot. And when a country threatens its closest economic partner with an economic nuclear option, it signals that the old assumptions no longer apply. The question now isn't whether tariffs arrive, but what this escalation reveals about how power is being redefined in trade politics going forward globally. Canada's outreach to China did not happen in isolation. Across the global economy, middle powers are quietly recalculating risk. For decades, efficiency mattered more than resilience. Now, after trade wars, sanctions, and weaponized supply chains, countries are diversifying not for profit but for survival. Canada's engagement with China fits squarely into that trend. From Ottawa's perspective, this is pragmatic economics. The United States absorbs the vast majority of Canadian exports, creating dangerous dependence on a single market. Expanding trade with China offers optionality, leverage, and insurance against future shocks. On paper, it looks rational, but Washington doesn't see it that way. To the U.S., China-linked trade is no longer just commerce, it is alignment. Every deal signals intent, loyalty, and geopolitical direction. In this framework, supply chains double as alliances, and markets become political territory. The question is no longer who trades efficiently, but who trades with whom. That is why Canada's move triggered such a strong reaction. It wasn't the size of the deal. It wasn't the immediate economic impact. It was the message it sent. A close ally, exploring deeper ties with America's primary strategic rival, crosses an invisible line. In Trump's worldview, neutrality doesn't exist. Economic engagement becomes a choice, and every choice has consequences. When Canada looked east, Washington interpreted it as drift, not diversification. And in an era where trade policy increasingly doubles as a loyalty test, that perception matters more than the numbers themselves. This sets the stage for understanding how Trump responds when power, not profit, is what he believes is at stake. To understand this moment, you have to understand how Donald Trump views tariffs. In traditional economic theory, tariffs are tools. They protect industries, correct imbalances, or support negotiations. In Trump's framework, tariffs are weapons. They are meant to shock, punish, and force submission. This isn't new. Time and again, Trump has used tariffs not as policy instruments, but as pressure points. Steel, aluminum, autos. The pattern is consistent. Threaten first, escalate fast, then negotiate from a position of fear. The economic efficiency of the tariff is secondary. The psychological impact is the point. In this context, the threat against Canada makes sense. It is not about fine-tuning trade flows or protecting workers. It is about asserting hierarchy, about reminding partners who holds leverage inside North America. A 100% tariff isn't meant to be sustained. It's meant to be unbearable. That's why allies feel this differently than rivals. Rivals expect confrontation. Allies expect coordination. When allies are treated like adversaries, trust erodes quickly. The signal becomes clear. Alignment is enforced, not negotiated. This strategy turns trade into a test of obedience rather than cooperation. And for Canada, deeply integrated but politically independent, that creates a dangerous vulnerability. When tariffs become tools of dominance instead of policy, even the closest relationships become conditional. That is the logic now shaping the next phase of this conflict. Canada's exposure begins with geography. There is no alternate superpower next door, no nearby market capable of replacing the United States. Roughly 3/4 of Canadian exports flow south, moving through supply chains designed not just to trade with America, but to function as part of it. Factories, energy grids, and logistics networks are intertwined so deeply that separating them would be economically painful on both sides. That integration is usually described as a strength, but in moments like this, it becomes a vulnerability. When a 100% tariff is even mentioned, investment decisions pause. Companies delay expansion, markets reprice risk, and uncertainty alone begins doing damage before a single policy is enacted. Canada's dilemma is stark. Compliance keeps borders open, supply chains intact, and capital flowing. Resistance preserves sovereignty, signaling that economic policy is not subject to external veto. But resistance also invites retaliation that Canada is structurally ill-equipped to absorb quickly. This is what makes the threat so powerful. It doesn't need to be executed to be effective. It exploits dependence. And while Canada has options in theory, in practice they take years to build. This is no longer just a bilateral issue. It exposes how deeply power asymmetries shape modern trade. And once that reality becomes visible, other countries begin asking the same question Canada now faces. The moment confidence erodes, diversification stops being a strategy and becomes an emergency response, reshaping policy choices, diplomatic posture, and long-term alliances in ways that extend far beyond any single tariff threat across the global economic system right now. Zooming out, this moment fits into a much larger pattern reshaping the global economy. The post-Cold War promise of predictable rules, neutral institutions, and gradual integration is fading. In its place, power is returning to the center of economic decision-making. History offers uncomfortable parallels. In the interwar period, trade fragmentation followed political distrust. In the 1970s, economic shocks redrew alliances. Each time, rules bent under pressure from states willing to weaponize access. What we are seeing now is not new, but it is accelerating. Trade is no longer governed primarily by efficiency or comparative advantage. It is increasingly governed by leverage. Market access becomes conditional. Supply chains become strategic assets. Tariffs, sanctions, and export controls become tools of influence rather than instruments of policy. That is why this moment matters far beyond Canada. Allies across Europe and Asia are watching closely. If Canada, one of the most integrated and dependable U.S. partners, can be threatened so openly, then no relationship is truly insulated from pressure. This creates a chilling effect. Countries begin planning not around growth, but around resilience. They hedge. They duplicate supply chains. They quietly prepare for a future where trust is fragile and economic ties can be turned off overnight. The irony is that power-based economics often produces the opposite of its intent. Coercion accelerates fragmentation. Pressure pushes partners to seek alternatives. And once alliances start to fray, restoring them becomes far more difficult than threatening them in the first place. This is the deeper signal embedded in the tariff threat, a world drifting away from shared rules toward managed dependence, where strength substitutes for predictability and uncertainty becomes a permanent feature of the global system, forcing every nation to rethink alliances, exposure, and strategic autonomy simultaneously under constant geopolitical pressure in 2026 globally. Three paths now sit on the table, and none of them are cost-free. The first is escalation. Tariffs are imposed, retaliation follows, and uncertainty hardens into policy. Markets would price in higher risk premiums, supply chains would slow, and investors would begin treating North America less like a unified production zone and more like a fractured region. The second path is quiet compromise. Behind closed doors, language is softened, timelines are extended, and both sides claim victory without changing fundamentals. Markets would rally on relief, but the lesson would linger. Investors would understand that access can be questioned at any time, even between allies. The third path is the most consequential and the least visible. Long-term decoupling. Not a dramatic break, but a gradual shift. Governments encourage redundancy. Companies build parallel supply chains. Capital flows hedge political risk rather than maximize efficiency. Each scenario offers short-term control but long-term consequences. Escalation demonstrates strength but accelerates fragmentation. Compromise preserves calm but normalizes threats. Decoupling reduces dependence but permanently raises costs. The danger is normalization. When economic coercion works once, it becomes tempting to use again. Over time, allies stop reacting emotionally and start adapting structurally. That is how pressure reshapes alliances quietly, not overnight, but permanently, setting the stage for the final question this moment leaves behind. Markets, governments, and voters will interpret these outcomes differently, but all of them redefine expectations about stability, trust, and the future cost of economic dependence across global trade relationships worldwide. This story began with a question about tariffs, but it ends with a question about power. The threat aimed at Canada was not simply an economic tactic, it was a signal about who sets the rules, who enforces them, and who is expected to comply. Power-based trade creates fear, not loyalty. Fear may deliver quick results, but it corrodes trust over time. Allies under pressure do not become more reliable. They become more cautious, more defensive, and more willing to explore alternatives once considered unthinkable. History is consistent on this point. Economic dominance lasts longest when it feels predictable. The moment access becomes conditional, relationships change. Planning horizons shrink. Redundancy replaces efficiency. Cooperation gives way to insurance. This is the hidden cost of economic power plays. They appear strong in the moment, but they quietly encourage fragmentation beneath the surface. Every threat plants a seed of doubt. Every ultimatum teaches partners to prepare exits rather than deepen ties. Canada may navigate this episode, but the lesson will travel far beyond its borders. In a world where economics is no longer neutral, alliances become transactional and trust becomes fragile. History shows that empires don't lose power when enemies rise. They lose it when allies walk away from the center outward.